Hello and welcome to the Ultimate Practice YouTube channel, the place where financial advisors go to learn how to make their practices as successful as they want them to be. Hey, it's George Hartman here, or as some people like to call me, that practice management guy. And after coaching top performing financial advisors around the world for more than 30 years on how to run their practices like a business, I'm okay with that. I'm pretty good with it, in fact. And speaking of top performing advisors, today I want to share with you part 2 of one of the best time-tested of the 150 plus coaches forum columns that I've written over the past 15 years for the industry trade journal Investment Executive, and presented to you in this video format, which we call The Coach Says. So if you watched part 1 of this video series, you'll recall that the structure is I respond to a specific question I've received from an advisor who wrote into my column. So let's get right into today's topic. Part 2 of 10 things top performing advisors do that others don't. And here's a brief synopsis of what our advisor Gary wanted to know about what separates top performing advisors from the rest. And Gary's message to us said, I've been in the industry for just a couple of years after an attempt at another small business didn't work out. What scares me is that I had a good knowledge of the industry from my previous business, but I'm now basically starting over in an industry in which I have little formal training and only limited knowledge of what it takes to be a successful advisor. In your experience, what separates the most successful advisors from the rest of the pack? Do they think differently or simply work smarter and harder? Well, first of all, Gary, welcome back. But before we get to the best practices number 6 through number 10, let me take just a minute to recap the first 5 habits of top performing advisors that we covered in the earlier video. Number 1 is having a clear vision for your practice. Top advisors know what their business will look like and feel like when it is as successful as they want it to be. Number 2, create a plan to realize that vision. With their vision firmly ingrained in their minds, top performers next create a business plan with a strategy that describes what they want to accomplish and then the specific tactics and tools that they will use to achieve their vision. Number 3, understanding the metrics of their business. Top advisors know the numbers in their practice, things like the impact of the resources that they use, so they can assess the value of results achieved against the cost of achieving them. And they can also predict the outcome from their business development activities, for example. Number 4, know your target market. Industry-leading advisors have a well-defined preferred client profile, and they orient their business to maximize the effectiveness of their promotional activities in attracting preferred client prospects. By having a well-defined client profile, top performers are able to become known as experts in solving issues specifically related to their target market. And number 5, have a compelling value proposition. Top performers have found a way to differentiate themselves in a very crowded advisor market by offering specific products and services that are relevant and appealing to people who fit that preferred client profile that they've developed. Okay, let's move on then to best practices number 6 through number 10. And number 6 is managing your pipeline effectively. Not surprisingly at all, top performing advisors are extremely good at managing the flow of prospects through their business development pipeline. More specifically, to stay ahead of their business, top advisors, in my experience, on average, have up to 5 times as many prospects in their pipeline as other less productive advisors do. And in addition to having more prospects in their pipeline, top performers also keep those prospects in their pipeline longer. But that's not enough. Just having more prospects and keeping them there longer doesn't fully explain the difference in these advisors' success. What does make a difference is that top producers also have a well-defined process for converting prospective clients into actual clients by moving them along a continuum that steadily increases trust and confidence and rapport, and thereby they're nurturing and deepening and strengthening those prospective relationships along the way. And this process provides an opportunity to progressively demonstrate more and more value so that prospective clients develop a greater understanding of what these advisors do and what they have to offer and why it's important for them to take advantage of the advisor's knowledge and services. Best practice number 7, using standardized processes to deliver customized solutions. Now, it's quite probable, Gary, that as a relatively new advisor through your firm or your mentor, that you've been exposed to a standardized process for determining things like client financial needs, investment risk tolerance, and things like that, and ultimately leading to recommendations. What top performing advisors have learned, however, is that the business of providing financial advice cannot be rendered to an assembly line-like process. They've found there are just too many variables in people's lives, too many emotional differences, and too many products and services to treat everyone the same. However, that fact does not prevent top-performing advisors from using a standardized process for efficiency in their operations. For example, let me describe a standardized process being used by one leading advisor with whom we work. Starts off with what he calls the welcome. New qualified leads are entered into the advisor's CRM system, which automatically generates a welcome message to let prospective clients know the advisor will be following up personally. And that follow-up he labels the introduction. It's a brief conversation or message to confirm the introduction and schedule a meeting or conversation to discuss any potential engagement. That engagement then, the third step, is a meeting or a conversation to determine if there's a fit between the prospective client's needs and the advisor's capabilities. And here the advisor gets a quick overview of the client's situation and describes next steps. And the next step starts with the discovery, the completion of a planning questionnaire and a risk tolerance assessment, and so on. A document checklist is also provided, and the responsibilities for gathering data and information are assigned. That then leads to the analysis, and this is the behind-the-scenes work, where the advisor completes an assessment of the client's situation and determines recommendations. With that complete, then comes the presentation. And at this meeting, the advisor reviews the client's situation, describes what they found through the analysis, illustrates recommendations, and seeks agreement to proceed, which then leads to the actual implementation. Any required paperwork to onboard the client is completed, and in this particular case, the first review meeting is scheduled. Now, it is important to note that although this advisor has these 7 steps in his process, they need not all happen independently. For example, in less complex situation, it's not unreasonable that the engagement and discovery steps would be combined into one session, as might be the presentation and implementation. Regardless of the number of steps used, the value is in the consistency and efficiency of the process and its ability to deepen and strengthen relationships gradually, while allowing for full customization of recommendations to recognize and respond to each client's individual needs. Okay, best practice number 8. Integrate marketing, sales, and service through segmentation. Now, most advisors think of client segmentation as a service-oriented activity, determining which clients receive what level of service. Top performing advisors, however, understand that there is an interdependency among marketing, sales, and service. And it goes like this. Effective marketing results in sales. Sales create a service commitment, and service delivery provides marketing opportunities through referrals, consolidating assets, fulfilling additional needs, and so on. And the cycle starts over again. And that's why top performing advisors ensure there is an alignment in the message their marketing conveys, that there's a link between marketing, sales, and service, the value proposition that they offer, and the service that they deliver. And by understanding how segmentation works across all levels of client engagement, top performers know that allocating much of their marketing and sales efforts towards their best clients, people who already trust and respect them, results in more new business opportunities through introductions and referrals and additional products or services. And finally, aligning service resources with highest value clients improves profitability. And speaking of profitability, best practice number 9 is to make every client relationship profitable. Now, many advisors can rightfully claim that they have profitable businesses. However, we know from our experience in practice assessment and valuation that while an advisor's practice may be profitable overall, that's often because larger clients are subsidizing the costs of smaller clients. And top performing advisors have long recognized that the simplest way to ensure a profitable practice is to make every client relationship a profitable one, which means ensuring that revenue per client exceeds cost per client. Top advisors also realize that revenue is a function of the client's needs and their financial capabilities. So we could say that in general, revenue is circumstantial, but expenses, on the other hand, are largely within the control of the advisor. And that's why top performing advisors implement policies and procedures that ensure service for lower value clients is delivered in the most cost-effective way, perhaps by self-serve system or technology or other team members, thereby freeing the advisor to focus his or her service time on the highest value clients. And this is not to imply in any way that all clients are not entitled to good service. They are entitled to whatever service they need. However, because top performing advisors know the metrics of their business, and if you watched part 1, that was best practice number 3 in part 1 of this video series, they can determine a service delivery regime that ensures profitability of every client relationship. That said, many top-performing advisors choose to retain some clients whose service costs are greater than their value to the business. Perhaps they're the children of a top client, or they want to deepen the relationship with certain younger and newer clients who have higher long-term potential. I'm also very happy to say that many advisors also serve a small number of clients on a pro bono basis because they want to give back to the community by offering their services to special people who might not otherwise be able to afford or access financial advice. And finally, best practice number 10 is creating clients for life. The final thing top performing advisors do well is to recognize that the lifetime value of a client far, far exceeds the initial compensation. As a result, these advisors work extremely hard to create clients for life. And in fact, this goal is actually the most powerful motivation for adopting the other 9 best practices. So what is the lifetime value of a client? Well, think about it, right? Of course, it's all the revenue generated from products and services that you provide to the client. But it's also all the revenue generated from a new client that you get as a result of introductions from the original client. And then all the revenue generated from the new client as a result of introductions from that client who came from introductions from your original client, and so on, for as many iterations as you want. Now, to further emphasize the importance of creating clients for life, we know from our research that the lifetime value of a client can easily be 50 to 100 times the compensation earned from the first transaction in, let's say, 10 years, which is not an unreasonable time to have a client. So, Gary, let me conclude by reminding us of what I said in part 1 of this video series, that most advisors have had to learn on the job, as you will. I also said it is unlikely you will have to master all 10 of these best practices, at least in the short term. However, becoming proficient at a couple or 3 or 4 of these habits will set you on the right path to being a top performer yourself. My very best wishes to you, Gary, for success in your journey. Now, if you enjoyed the video you just watched, please click on the like icon. And if you haven't subscribed to our channel yet, click on the subscribe button to receive notifications of new videos as they are released and to join our community of advisors looking to become as much as they can be. And if you didn't catch part 1 of the 10 things top performing advisors do that others don't, check that one out as well for a more fulsome description of the first 5 which I described at the beginning of this video. And finally, if you'd like to receive ongoing communication from me with insightful content like this, not just videos, but other written pieces and so on, please leave a message in the comments section and we'll add you to our email list. And finally, as always, my wish for you is that your practice will be as successful as you want it to be. See you next time.